Hey, it's Stuart. Let's talk about debt recycling. What is it? Is it really worthwhile? If you do a short Google around debt recycling, there's plenty of articles sort of talking about repaying your home loan, then borrowing against the equity to invest in shares, and then using the investment income that you're getting from that share portfolio to repay your home loan. And they suggest that it accelerates the repayment of your home loan. So that is, you can do it faster than if you didn't have those shares. But I think we're getting confused, and maybe I'm a bit skeptical, but perhaps it's more of a sales spiel than a fundamental financial strategy. So the whole idea around debt recycling is to try and convert good debt bad debt to good debt. Bad debt being non-tax deductible debt, your home loan, and good debt being debt used to buy assets that will appreciate in value. So investments, share market investments, property, those sorts of things. The idea then is the more investments you have gives you more investment income, which you can put towards the retirement or repayment of bad debt, your home loan. The problem is, let's look at the numbers, right? So if we wanted to invest in a way that we're going to maximize income, the best way to do that, I mean, the highest yielding share market, geographical share market, is Australia, pretty much. I don't know of another geographical market that has such a high dividend yield. And there are, in fact, Vanguard has one, VHF, I think the ticker code is, which is a high yield ETF that will generate pre-tax, so including imputation credits, about 8% per annum in terms of income. The problem is, though, if you go and borrow to invest in that, what's your interest rate? Your interest rate's about 7% as well. So from a cash flow perspective, sure, you've gone and bought these investment assets, but from a cash flow perspective, you're going to be about neutral. I mean, maybe you'll be slightly better off, but broadly neutral. And I typically would do my numbers in terms of long-term projections, assuming an interest rate of maybe 6.5-ish%. So if we're getting sort of 7, sometimes you can get 8% in some years in terms of investment income. You might be 1% better off, but it's not going to be that material. You know, you're not going to do it because you think it will repay your home loan faster. It could, and that might be icing on the cake, but it's not really the reason you should do it. But in a low interest rate environment, of course, debt recycling works fantastically well. For example, 2 years ago, when I can borrow on a fixed rate at 2%, invest it in the share market and get 7%, I'm 5% better off pre-tax. I'll need to pay tax on that income, of course, but it can go into the home loan and it'll help me repay it faster. So in a low interest rate environment, debt recycling works. In a normal interest rate environment, it's negligible. There's not a big saving to be enjoyed. The examples that I read on the internet around debt recycling was really more about using debt for investment as opposed to cash. So for example, they often say, okay, if you've got a home loan and you've got 100,000 in the offset of that home loan, instead of using that 100,000 of cash to invest in the share market, repay the home loan and establish a new investment loan for 100,000 and use that to invest in the share market. That I agree with. You know, that is definitely the right strategy. And perhaps I can summarize that strategy to say all available cash savings and cash flow should go directly into your home loan to reduce bad debt, to reduce your home loan. If you want to make investments, borrow to make those investments. Don't use your own cash. All the cash should go into the home loan to reduce that non-tax deductible debt faster. And there's some emotional reasons for that. Everyone wants to own their own home without a mortgage, of course. Eventually, that's most people's goal. But mathematically, the cost of a home loan is almost twice as much as an investment loan, depending on your tax rate. And the reason for that is a tax deduction. You know, if you're paying 7% and you get a tax deduction, the highest marginal rate, your after-tax rate is sort of about 3.65%, you know, after you get the 47% tax deduction. Whereas with a home loan, you're paying 7%, you don't get any tax deduction, your after-tax cost of debt is 7%. So as you can see, investment loans, because we get a tax deduction for them, are really half the cost if you're a high income earner than home loans are. And that's why you should put all your money towards your home loan, including cash saving, and borrow to invest. So I think that's the strategy, not debt recycling per se. Anyway, I hope that explains debt recycling and explains why I don't think it's a huge benefit unless you can borrow cheaply. Unless you can borrow maybe 5% or lower on a long-term basis. Good luck to you if you can. I certainly can't. But it's really just around using debt to fund investments and putting all the cash into your home loan. That's the key element in this strategy. Cheers.